Good evening and welcome to the discussion on economy and markets being organized as part of the month-long India Economic Forum. Our financial markets are a visible indicator of our economic strength and financial stability, since the operational robustness of financial markets is directly related to the functioning of the economy. Financial markets can be labeled as a matter of national importance. Therefore, it becomes necessary to discuss in detail what are the issues that financial markets in India face to ensure that the functioning of the economy is not disrupted and common investors' interests are not hurt. It remains a fact that the financial markets are as strong as the institutions backing them. Stock exchanges have played a major role in the growth of the economy, and they continue to do so every day, with a few aberrations as we see these days due to the external factors. The issue of governance in stock exchanges also garners paramount importance. In this panel on economy and markets, we aim to analyze what are the major concerns of India's financial markets and what are the solutions. Amongst other things, the panel discusses, is there a disconnect between the stock market and the real state of our economy? Are IPOs fairly priced, or should it be left to the market to decide fair value? Are there adequate safeguards to protect small investor interest or investments, and much more? With this, I have the pleasure of introducing our chair today, Mr. UK Sinha, former chairman, SEBI, and distinguished fellow SKOCH Development Foundation. He was earlier CMD of the Unit Trust of India Asset Management Company, commonly referred to as the UTI Mutual Fund. He also chaired the RBI Expert Committee on Micro, Small, and Medium Enterprises. He was conferred the SKOCH Challenger Golden Jubilee Award for his contributions to the market reforms during his tenure as Chairman SEBI. Welcome, sir. Our panelists are Mr. Siraj Hussain, Senior Visiting Fellow ICRIER, an agriculture, food policy, and agro-processing expert. He was Secretary, Ministries of Food Processing and Agriculture, and has authored several research papers on agriculture and rural economy, and his columns have been published in several newspapers and online portals. He was also CMD of Food Corporation of India. Ms. Lakshmi Iyer, President and CIO, Debt and Head Products, Kotak Mahindra AMC. She's been with the organization for over 2 decades and has been managing credit research and fund performance across all debt funds. In addition, she has been a portfolio specialist and managed product-related initiatives such as product pricing and coordination with the fund's management and sales teams in that role. Mr. Madan Sabnavis, Chief Economist with Bank of Baroda. He has been a corporate economist with over 30 years of experience across development banking, commercial banking, engineering, commodity exchange, and credit ratings. Author of 4 books, he is on SEBI's CDAC and RAC committee, IIBEF's RAC committee, and education committee. He has been chairman and co-chairman of the committees of BCCI and IMC. Ms. Radhika Gupta, MD and CEO of Edelweiss MF. She is recently elected as the vice chairperson of AMFI, started her career with McKinsey, an asset management professional with experience across asset classes and investor segments. She successfully led Edelweiss's acquisition of JP Morgan's mutual fund business and Ambit Capital's AIF business in 2016. Ms. Aditi Nair, Chief Economist, ICRA Limited, leads Indian economic research as well as state finances research and ratings. Her focus areas include macroeconomic analysis and forecasting, policy assessment, as well as fiscal analysis and debt sustainability at the sovereign and sub-sovereign level. She's been a part of several credit rating exercises for sub-sovereign debt in India, including debt raised by state governments and state-owned entities. And Mr. Samir Kochar, reforms historian and chairman, SKOCH Group. Before I invite our chair, Mr. Sinha, I invite Mr. Kochar to say a few words.
I welcome you all. It is indeed a pleasure to be in such illustrious company. I don't understand markets much, except those are the places where I always lost money in my life. Never ever made one. So I am here actually mostly to listen than to contribute. But some of the issues are, what is going on around us is obvious. We have India 2047, which is not just a milestone of 100 years, it is also a milestone of, it's also a target. A lot of things are targeted, like India becoming a developed country by then, upper middle income country by then, and so on and so forth. So while all that is true, where are our markets? What is the kind of infrastructure spending that is required? Where are the bonds? Where are the corporate bonds? Where are the municipal bonds? Where are the agriculture markets? Where are the commodities markets? So we have actually specialists in every area practically in that. And I'm sure that Mr. UK Sinha will very ably guide us through a lot of questions that this panel is supposed to answer. But I'm very, very keen and curious to understand that in terms of economy and markets, where we are and where we are going, specifically in context of India 2047 and the formidable targets that we have. Over to you, Mr. Sinha. Welcome.
Thank you. Welcome everybody for this flagship event and the flagship session of this flagship event. And I have a very eminent set of panelists. What I want to begin in by saying is that the world and India both, we are passing through some unprecedented times, especially since the last 2 years. Nobody could have imagined the type of things we saw in 2020. And when things started looking up, again, some new geopolitical developments have occurred, which are again placing some question marks on our forecasts and on our standards of living across the globe. You are aware that the IMF, which had forecasted that the world growth for the year 2022 would be around 4.9% in October, then they have now brought it down to 4.4% in their January this year forecast. Similarly, a lot of other headwinds are also quite visible. And also, in India, on the other hand, we are seeing that the government has come out with a policy announcement in the budget for a infrastructure capital investment-led growth. There are questions around whether this is going to crowd out other investments or private investments or not. As mentioned earlier, our markets are doing reasonably well. If you look at the numbers from the starting of this financial year, and I had numbers till 10th of March this year, I find that the Indian market has given a return which is perhaps best in the world compared to markets like Korea or markets like USA or even China and things like that. On the other hand, we are also seeing that foreign portfolio investments are seeing outflows in the recent months. But the mutual fund inflows are continuing to be robust. So we have a whole set of mixed in. So in all this background, the new development which has come from the situation in Europe is posing a question mark. And the immediate impact on the commodity prices is very well known. Everybody has started feeling it. And of course, the runaway case of trading of nickel in the LME on 8th of March went from the range of around $25,000 to $30,000 a ton. It went up to, it crossed $100,000 in a matter of few hours, and the trading had to be cancelled. Today, as we speak, the trading is about to start, or it might have started earlier today, the 16th of March, it was about to start. Oil prices are of course something which we all like to discuss. So in this background, what I propose is that I'll request all the panelists to make some opening remarks lasting maybe 2 to 3 minutes each. And after that, we will have a set of questions. I'll also have some set of questions. Maybe we'll have some questions from the audience. So I'm calling my panelists, not in any particular order, So I like to first invite Aditi Nair to make her remarks, please.
Thank you so much, Mr. Sinha. Good evening, everybody, and thank you so much to IEF and the SKOCH Group for inviting me to be part of this esteemed panel. So, sir, you've given me just 2 to 3 minutes. I'm going to try and set the macro context since I'm going first. So, the context for the Indian economy that we see at present with the heightened geopolitical conflict. So, just stepping back from that, basically, we had a slightly weaker than expected GDP growth performance in Q3. And after that, we found ourselves amidst the third wave of COVID-19 in the first half of this quarter. When we look at the impact of that, the restrictions did have an adverse impact on contact intensive services and mobility. But broadly, the industrial sector was not very affected by the third wave or by the restrictions which came about. So we did find that there was better preparedness that helped to insulate the economy from the third wave. More importantly, confidence was really not very badly affected by the third wave, which is what we saw through the RBI surveys. And this is something which is very promising in terms of the chances of a rapid rebound after the third wave was over. However, right out of that rebound, we have gotten into the geopolitical tensions. And as Mr. Sinha pointed out, the biggest impact has been on commodity prices, which have grabbed the headlines over the last few weeks and really roiled the markets globally. So I'm going to offer some forecasts of the Indian economy, some of the key macros for the Indian economy for FY23, with this big caveat that the one factor that's going to affect our estimates the most is how long the conflict actually lasts, and the impact that that has on keeping commodity prices at this unsustainable or unnaturally high level, which is driven more by geopolitics and by demand conditions going forward. So I'm going to start with crude oil. That's what's on top of everybody's mind. Our assessment is that for every $10 billion increase in the average price of the Indian crude oil basket, the net oil imports widen by about 14 to 15 billion, for the year as a whole. And if crude oil remains at the current $100 per barrel, the current account deficit is likely to be relatively manageable at 2.4% of GDP in FY23. After the conflict subsides, we believe that crude may recede back to $80 per barrel, which is something that the Indian economy should be able to manage quite comfortably. So really, it's going to be the period for which crude remains this elevated, which is going to determine how much pain we have going forward. Another source of concern has been the currency. The INR has been amongst the weakest performing EM currencies so far in this calendar year. But of course, our very large foreign exchange reserves have acted as a buffer. So going ahead for the USD INR cross rate, we expect that in the duration of the conflict, it's likely to remain in a range of 76 to 79. But after the conflict subsides, we do expect it to come back to a range of maybe 74 to 77. So that is again some amount of volatility for businesses and markets to brace for going ahead. On the inflation side, of course, commodity prices transmit very rapidly to the WPI, but not so quickly to the CPI. So there are three major sources of concern that we do have for the CPI inflation. One is edible oil, one is gold, and the last, of course, is crude. And it's not clear whether we're going to have an excise duty cut, which is going to be brought in to be able to douse the impact of crude on the CPI inflation. As of now, we are afraid that the Indian CPI may average as much as 5.5% to 6% in FY23 and be very close to the upper threshold of the Monetary Policy Committee's medium-term range. On the fiscal side, the outlook is quite mixed. We have negatives coming in from higher fertilizer subsidy requirement, potential excise duty cuts, and some hit to corporate profitability if commodity prices stay high for an extended period of time. But a low nominal GDP growth, a very modest embedded tax growth, and the spillover of the LIC IPO proceeds should be able to provide a very significant amount of cushion to Government of India's fiscal deficit going ahead. So on the agri side, I'm going to defer to our expert. I won't spend longer than a minute. But broadly for the Indian GDP growth, we now see growth somewhere in the range of 7 to 7.5%, with a very clear K-shaped recovery to continue going ahead, and the formal sector to continue gaining market share at the cost of the informal sector. As a result of which, we also expect the divergence between the financial markets and the real economy to persist. So I'll stop here, sir. Back to you.
Thank you. Thank you. Mr. Sabnabis.
Thank you, sir, and good evening to everyone. I will not repeat whatever Aditya said, because as economists, we may have slight variations in our numbers. But I think a couple of things which all of us should be watching out for, I think, is one is about the RBI's and MPC's stance on growth as well as inflation. Because we've had this peculiar situation that even though we had the mandate given to the MPC saying that you need to target inflation, inflation doesn't really seem to be mattering as far as the MPC is concerned, because the view taken is that since growth is not durable as of today, therefore there will not be too much of attention paid to inflation. Now, ideologically, one can always say that are we actually doing the right thing in terms of targeting the CPI? Because the CPI actually doesn't make any sense, because if I reduce the rates or increase the rates, my CPI doesn't go down or up. So it actually only affects the so-called real interest rates. That's the way we're looking at CPI. So we need to seriously look at that. But it so happens that when the MPC review did take place, they've decided to continue with status quo looking at CPI. But I think RBI will have to take a call at some point or the other to say whether this inflation is also transitory or not. So far, I think globally also, I think lots of central bank heads have been saying that inflation is transitory. Now, how long can it be transitory? Because we've already seen inflation being up around 7% last year. This year also, it's averaging 6%. So is 6%, 7% not transitory? Isn't that a firm kind of number? So I think that is something which they will have to look up. Second is, of course, the government. I think the government has been sticking to the fiscal plan of fiscal consolidation. And I think lots of things have gone topsy-turvy, because when we keep reading of supplementary grant being asked for from the Lok Sabha, we had it round 1, round 2, now we have round 3. So quite clearly, all the budgetary numbers have gone topsy-turvy on account of these developments which have taken place. So I think the government should also probably think of whether at all, before the new financial year starts, should they actually review all the budgetary numbers. And because there's no point talking of disinvestment of LIC happening next year, and we already have 65,000 crores being targeted for next year, 130,000 crores, I don't think the market has the appetite to absorb so much of government PSU paper. So that's something which I think the government should look at. That's point 2. And the third thing is, I think another unusual thing which has happened is the way in which the markets have behaved. So I'm slightly deviating from economics and going into the markets and saying that what we've seen has been short of being absurd, because we've had the economy going into, I mean, this happens all across the world, not just the Indian market. We had negative growth rates, but stock markets have done very well. So is there actually a relationship between the two of them? So my sense is that what's really happened is that the entire world has gotten into a situation of excess liquidity, very low interest rates. And it is, if I talk of India, I think we've reached a situation where if you're a household and you're putting money into savings in a bank, you're actually ruining yourself, because with 6% inflation, return of 4 or 5% from a bank deposit, you are actually nowhere. So for lots of us who are working, it's maybe all right. But once I retire, I think I'll be really concerned with the fact that I'm getting negative returns and return of just 5% from my deposit. So I think that's the problem we have here, which I think everybody is worried about. That why is it that so many retail investors are going to the stock market? I don't understand the stock market. I start investing money there, I lose my money, and then everybody says, "Look, you come into the market with your eyes open." So they can be. I mean, the regulator cannot take sides on who are the gainers or losers. And another crazy thing which has happened is cryptocurrency. People start putting in cryptocurrency. First, we keep saying that, look, nothing wrong is there in cryptocurrency. It's small. And today, by the time you decide that there is a problem, you suddenly realize there's already lots of investment which is there, and you can't possibly ban it. But what happens? Lots of people have lots of money which has been invested there. So I think this whole business of greed is good. I think I remember this movie Wall Street, where Michael Douglas says greed is good. I think all of us thought the greed is good. We start investing, and finally, at the end of the day, I think what happens is that there are some people who make money, but invariably the retailers are left with making the losses. Because the whole scheme is such that when I'm selling, somebody is buying. When I'm buying, somebody else is selling. So somebody makes money, and I don't know when to sell as an individual retailer. So I think that this is what I think the regulator will have to take up quite seriously about this entire craze which has gone into the stock market. And today at 60,000, say the Sensex, can we really reasonably say that I'm going to jump to 90,000 in the next 5 years? I think nobody's really sure about it. So I think that's my limited view on the markets and how we should be looking at them. Thank you, sir.
We'll also have a question on regulation as we move forward. But I think you are in the same league as Samir Kochhar so far as not investing in the market or not understanding the market. So it's high time I bring somebody from the market. So Radhika Gupta, can you please come in and tell us, come out with your opening statements?
Sure. Thank you, sir, and thank you for having me. And since a lot of comments were already made about the economy, I'll focus my comments on the participation of retail investors in the market, which was, the point that was recently made as cryptocurrency, and perhaps how we should see the landscape going forward, the pros and cons of it. So I think the macro context to this is very, very clear. India continues to have one of the highest savings rates at 28%, and there's no reason to believe that it won't continue. And financialization, I think the clear switch to financial assets is visible and will continue to happen. So physical assets compared to 8 years ago are down from 40 to 30%. Financial assets are now up significantly. And with more literacy, I think the long-term performance of the market, and I'm ignoring short-term concerns around Ukraine or geopolitical concerns, I think this will happen. Of course, some of the industries that we represent have been beneficiaries of this, whether it is mutual funds or insurance. So MF as a part of GDP in the COVID period went from 0.2 to 1.7. And you continue to see a steady growth, whether it is in the number of individuals doing SIPs, the role individuals are playing in both cash and derivative markets, and the steady growth in demat accounts. Now, what I think are the pros and cons of this is, where I make my comments. And I think that there are 5 things to keep in mind. One is that the opportunity is massive and inevitable. If you look at counterparts like China and the US, the trajectory they went through in terms of financialization, people's participation in the markets, there is a massive opportunity. In fact, I would say that if you just look at the numbers from China, the medium-term opportunity is for participation to be 3x. And if you look at the opportunity from the US, the opportunity is much, much larger. Secondly, I think with a younger and more aspirational investor base in India, there is a reason to believe this trend will continue, not just in financial assets, even in assets like cryptocurrency, and with easier payments through UPI, more net access, and the rise of digital brokers, because a lot of the growth that we've seen in the last 2 years has been digitally driven growth. There is reason to believe that this trend will continue. My point is that I think it is very important to make sure that this trend is a responsible one and it sustains. Capital markets are, of course, extremely cyclical and extremely volatile. And one of the things that is always top of the mind for us is that the people who have come into capital markets in the last 18 to 24 months are essentially, if I can put it lightly, children of bull markets. They haven't seen volatility. And the tragedy would be to see them exit the market because of one correction or one bout of volatility. So the key, I think, is to make sure that this very healthy trend of increased financialization, younger India, driving digitally led growth in stock markets and mutual funds sustains. There is tremendous responsibility on all of us as capital market participants in terms of our behavior, in terms of the kind of products. The fact that a lot of the money comes in via systematic investment plans, and I will come to that, is actually a very healthy trend, because SIPs finally blur out some of the volatility that was being referred to. And if you look at generally an SIP investor's experience, things don't go drastically wrong. The fact that people are coming into lower risk mutual fund products, hybrid products, blended products, All of these are good signs because we want to make sure whatever kind of capital market growth we have is sustainable capital market growth. And I would reiterate, I think the responsibility is on capital market participants to make sure that the growth is sustainable. You don't want what happened in some of the IPO market instances, and perhaps we'll come to that in a question. Investors coming into speculative names, losing large amounts of money to take away faith from the capital market. So I think that is a significant responsibility on us. But finally, I do believe that this trend will be one of the most significant trends for India. We have seen tremendous capital market volatility over the last 3 months. We've seen a large amount of FII outflows. But the fact is, DIIs have been, domestic investors have been real and constant participants and supporters of the market. Over the last 5 years, the amount of money we've received in humble SIP flows has actually been significantly larger than what we have seen in FII flows. So if we build this and capitalize on this opportunity well and build it in a sustainable way, its long-term impact on Indian capital markets is a very healthy one.
Now let us bring somebody on agriculture, because we have heard about the economy and the financial markets. So, Mr. Siraj Hussain, what are your opening comments?
Good evening. I think it is now widely recognized that in the last 2 years, COVID hit economy was saved to a large extent by the resilience of the agriculture sector. And as a result of that, the contribution of the agriculture sector in GVA rose to about 18.8%. Moreover, when millions of people trekked back to their homes on cycles, foot, tractors, briefcases, etc., we found that agriculture provided them some kind of employment and a little bit of income through which they survived. Now, having said this, we must realize that there are a lot of challenges. Even though we have been performing very well in the last couple of years, I remember, Mr. Sinha, when National Food Security Act was being enacted, was being debated from 2009 to 2013. Everyone was discussing and questioning how is India going to procure 60 million tons of food grains. It looked as if we will not be able to achieve that target, and we will not be able to fulfill the mandate of providing wheat and rice at 2 rupees and 3 rupees a kilogram to 67% of population. Now, last year, we found that the normal allocation of food grains plus the allocation due to COVID, which is called Pradhan Mantri Anna Yojana, it touched 90 million tons. And the panelists would be very happy to know that India met that target of providing 90 million tons of food grains last year. And this year, I think that will be even higher than 90 million tons. Now, I read a news today, I'm in Lucknow, in Dainik Hindustan, that the government is considering to extend this extra allocation till March 2024. I will not be surprised if that comes. But there is going to be a little bit of challenge because of this war in Russia and Ukraine. Now, about 30% of wheat and wheat supplies and a higher percentage of sunflower, etc., is going to be out of the market. So there is a lot of scope of export of wheat from India this year, and I'm sure the private sector will utilize that. But that is going to affect procurement. So I do not know whether we can meet this 90 million tons target of distribution going forward in the next 2 years. Now, we must also realize that, the farm laws have been under discussion. I have written about it. Mr. Madan Sabnabis has also written about it. We are not on the same page on this subject. So I would end by saying that not all is lost. There is still scope for state-wide reforms, which are spearheaded by the state governments. But there is at least one area about which I have written several times, on which the center has to take initiative. And I think now that the elections are over, the center will take the initiative. And that is interstate trade. For that, we need a central law, not enacted in the same manner as in which these 3 farm laws were enacted, pushed through, rushed through the 2 houses of parliament without reference to the standing committee. We do need a law for interstate trade so that no state is able to ban or restrict trading of agricultural commodities or movement of agricultural commodity from one state to another. So there is still a lot of scope for states to undertake that. And I will finish by saying that the new government in Punjab, AAP government, and the existing government in Haryana will be tested over the next 3 months, how they support wheat exports. Because we have seen in the past that wheat has normally been exported from Gujarat, Madhya Pradesh and UP. Because of high taxes and higher cost of transport, the exporters have preferred wheat from these 3 states. Now, Punjab and Haryana have to do something to enable their exporters to procure wheat from there so that their system is not overburdened. So we are watching that with interest. So I'll end there, Mr. Sinha, and then look forward to more comments.
Yeah. I will have some more questions for this in the next round. So now I invite Lakshmi Iyer, please.
Thank you, Mr. Sinha, and a very good evening to all of you present here. My opening comments would just be a summary of whatever I have heard, so far, both from an economy perspective and where we are headed from here forward. And to, kind of consolidate my thoughts, I was just writing down something as I heard Aditi, Madan, all of you speak on where we are from an inflation perspective. The key reason has been because it's one joker in the pack, that is oil. Oil has been on a boil, and because of that, in bond markets, the yields have actually had to toil. We actually saw yields go up to all the way up to 7%, if you see, before actually coming down. Suddenly, the market plan sees a foil as oil headed in the direction of soil. So what is happening is, as and when you're seeing oil prices head up, we saw almost $140 on crude, to 138 to be precise. Today, we are right now as we speak, we are close to about 98. The gyrations in the bond market or the bond yields have been clearly reflecting this one commodity as a key ingredient. So why is oil so important for the markets? Because obviously it is the largest, import guzzler from a bill perspective, and therefore it impacts your current account deficit. There are various estimates. I'm not getting into the economics numbers. It impacts, so as a commodity being one C, it impacts your second C, which is current account. The third C is therefore the CPI. And all these 3 C's put together are currently creating a sea of deluge for the bond markets. And in that sense, as you are morphing from an era of Triveni Sangam. Now, Triveni Sangam essentially is the confluence of 3 factors right now, which is high liquidity, low rates, and growth being pretty much on track. From that confluence or a happy confluence, you are actually, morphing yourself into a period of normalized liquidity, stable to rising interest rates, and a potential derail, not completely destabilizing growth, but a potential derailing of your growth target. Because if crude continues to be, premised on say $110 a barrel, it obviously has potential to knock off anywhere between 0.5% to 1% on your growth prospect. So clearly, this is going to be the dilemma, which is for interest rates in India. It is going to be the growth versus inflation dilemma, which is back with a bang. And in that sense, therefore, I think the policy making is going to get that much more challenging. And therefore, the RBI's role is not envious in the least, wherein there is going to be this tug of war between what to support and what to really prioritize, though obviously there is a role of an inflation vigilant which the central banker has to play. They can't let go of the growth prospect. One thing is clear, that if the inflation shock is predominantly supply driven, then we can see a slightly more accommodative stance from Reserve Bank of India instead of the narrative which the US is adopting, which is fastest finger first. So that can work in Kaun Banega Crorepati, that is working in the FOMC right now. And as we speak, if you look at the FOMC, it is talking about discounting of 7 rate hikes. And this is excluding the one that is likely to happen in March, which is widely expected to be 25 basis points. So we're talking about 8 rate hikes. The 10-year treasury at 2.2 has pretty much discounted all of these negatives. So I think there is a three-pronged approach which central bankers globally are taking. One is the KBC style fastest finger first, which has been taken by the US. Intuitively so, inflation touching 8%, interest rates at 2%, negative rate of 6% thereabouts, compared to where we are today in India, which can take a slightly more reasonable stance, because if you look at our 10-year benchmark and our inflation, there is still a positive real rate in the offing, though it's a minor gap. And then there is the rest of the world, which will be toggling around between growth, which is going to be the biggest concern for most of these regions. So I think interesting times ahead from a bond market perspective. You cannot be, completely forgetting the fact that carry or the yield game is going to be something which will be a predominant earner of returns for fixed income investors.
Thank you. Now I'm going to invite Aditi. And Aditi, I have two sets of questions for you. One is that given the constraints and challenges for the Indian economy today, what is your sense about the path that the Indian growth trajectory will have? You have any particular numbers in mind, and why? And what are going to be the main components of that growth? Which sector is going to come to the rescue? You can develop a scenario that you have in mind and tell us what is going to happen here. And my second question is that it is generally believed that the current budget has focused on capital intensive growth. So the question is it going to crowd out private sector investment? And what will be the interplay? How important that is going to be? So Aditi.
Sure, sir. Thank you so much. So, sir, I'm going to actually merge these two questions together for the first part of my response. Okay. Sir, in terms of looking at the growth outlook, now I'm going to go back to a slightly dated data point, which is the capacity utilization that the RBI has shared with us. The latest number is 68% for Q2 of FY22. Mm-hmm. And we are expecting capacity utilization, despite the third wave and despite the hiccups from the current conflict, to go up to about 72% by the end of this quarter. Thereafter, we are expecting a very slow up move. The reason being that as behaviors normalize and as people get back out there, get back to work, get back to school, my suspicion is that we're going to have more of disposable income going towards the contact intensive services, which is where we've seen a dip for the last 2 years. So to some extent, demand for goods is going to be slightly on the lower side in terms of the growth going forward. Therefore, I believe that capacity utilization will only go up to about 75% all the way by the end of this calendar year. Mm-hmm. And 75% is generally the threshold we believe needs to be achieved before there is a broad-based push from the private sector to go ahead with capacity expansion. Okay. In the meantime, PLI sector, cement, steel, China +1, Make in India, we are seeing capacity being added because of these thrusts. But broad-based, we believe, is going to take a little bit of time. In the meantime, we were very hopeful that the government CapEx program would actually kick off early, support sentiment, support the core sectors, and get things moving until the point where the private sector is ready to jump in and start investing more. So we are actually very hopeful that that was going to come in and drive a better pickup from the private sector. But I want to point to one short-term risk before I go to your medium-term question. A large part of the increase in capital outlay budgeted by Government of India is actually toward the 50-year interest-free loan being given to the state governments. And over there is an execution risk. Firstly, we're shifting an execution risk to the state governments. Sometimes they tend to kick off their spending a little bit slowly. Secondly, we're not clear at this point in time. We've heard one state sort of saying that they are not interested in taking this loan. They don't want the conditionality, etc., etc. We don't have enough details of the scheme in the public domain yet to be able to understand. how much appetite will there be across almost 28, 29 states and union territories for really going ahead with this scheme? So I do think there's a little bit of an execution and takeoff risk which is there, which will determine whether we actually get that big bang coming in from government capex early on or not. But over the medium term, I am more hopeful. I remain hopeful that with a young and aspirational population, eventually, if the jobs are there, consumption will come back on track. I'm hopeful that the policies which are being put in place right now will also support more sustained exports, including on the services sector, and that growth will come back to a steady state. But I don't believe we're going to get to that aspirational level of 8% growth on average over the medium term. I'm afraid our growth is going to get stuck in a 5 to 6% rut. And I'm even more afraid that that corresponds to an inflation which is above the 4% target of the MPC. So I would imagine that with a 5 to 6% potential GDP growth over the medium term, we may still be stuck with a 4.5 to 5% CPI inflation on average. And that is again something that's going to keep policy choices a little bit complicated over a longer period of time. Picking up a little bit from what Lakshmi was saying, I think we're in for just a couple of rate hikes from the MPC in this part of the cycle. I think interest rates in general are going to rise ahead of what the MPC does, mirroring what's happening in the global markets. So possibly we're in for a short cycle right now, because I completely agree the RBI and the MPC will try to support growth for as long as possible, especially given the supply side constraints, and it's really not demand which is overheating the economy at this point in time.
Okay, thank you. Mr. Sabnavis, I have two questions for you. Let us move away from India and look at some of the global challenges and global developments. First is your crystal gazing on when and in what manner, at what speed the rate changes are likely to take place in the USA or in the European markets, and how are these going to affect us in the short term and also in the medium term. Secondly, coming back to India, and a point was made that we have a K-shaped recovery. And I'm also noticing, and all of us are noticing, that MSMEs have been facing a lot of problems. The last data that I saw was that additional 20,000 crores of NPAs have developed only in the MSME sector. So in the MSME sector, how do you think the whole developments, whole scenario is going to play out? And how effective the government's program on providing welfare support is going to be actually helpful. So one about the global macro and one about the Indian situation, especially the inequality part or the stress on the MSME part. Please.
Thanks. So, on the first question of what's happening globally, I think it's more or less certain that there will be a rolling back of the quantitative easing in the developed markets. This will also go with interest rates going up. Now, as far as India is concerned, why should we be worried? I think the main concern comes through the investment flows which take place, because our growth is basically domestic oriented. So while we definitely need to keep in mind what's happening globally, but Federal Reserve's interest rates should not be a factor which is influencing the MPC, because we have already said that we're targeting the 4% inflation number. And now that we are saying that growth is not durable, therefore it should not really matter. But the concern really is that as interest rates keep increasing in the US, and if we do believe that it's going to be, say, 200 basis points, if we're talking of 8 interest rate hikes, it'll obviously mean that emerging markets become less attractive for foreign investors, and therefore the FPI flows which were coming into the emerging markets will definitely slow down. This is something which was already evident in India even before these moves have taken place. If we look at the FPIs into both equity and debt are negative, maybe there are different sets of factors which drive, which sort of motivate the FPIs. And I think this will only get exacerbated as we go ahead. So therefore, the concern more will be in terms of saying that higher interest rates will militate against the flow of FPIs. On the positive side, of course, higher growth also means that there's chance for India to leverage exports. So I think that's one area which we need to work on to see that if there is a growing world economy, whether the Indian exporters are able to take any advantage of that. Now, the second point in terms of the SMEs, yes, the SMEs have been affected by the lockdown. And I think most of our responses which were there, which I can't blame a government because I think that's what the government can do, is on the supply side. So it's a case of saying that, okay, the SMEs had a problem. So we had this emergency credit line, and I think they have benefited a lot. There's been a lot of restructuring of the assets, which have also of their assets also, which have taken place. So I think this has provided a lot of short-term relief for the SMEs. But I think the problem which is there in the SMEs is that it's more ingrained in them, in the way in which they operate. They're too small. They're not professionally run. They don't really have professionals who are running it. Most of them are owner-driven. Their fortunes are linked to the larger companies. So if the larger companies don't do well, they will have a problem in terms of the payments. And that's exactly what happened during the time of the lockdown. So to my mind, I think these problems are going to surface as and when these buffers which have been provided to them on the credit side end. And one is not also sure that the emergency credit line which has been given, so we'll get to know after a couple of years whether the SMEs are in a position to repay the loans or not, or whether the central government will have to actually, the guarantees are invoked and the center will have to come in and pitch for that. So I think the SME piece is something which we've always been talking about. It's something like the corporate debt markets. Even in your regime, we were talking of developing it. We all know what the problems are, but we just see that things really don't happen. And the problem with SMEs actually is probably more intricate because they're not really organized. So I think what is really important is that we need some kind of an organization for them, like how you have the CII and the ASSOCHAM. I think somebody who really talks for them. We do have certain mouthpieces. There are seminars which are held continuously, but somebody who actually does more than the regular lobbying which takes place to ensure that whatever problems are there are actually sorted out within the SMEs themselves. Because I think a lot of them have to come from within. And even today, we see that most of the so-called organized SMEs are only the larger ones. The moment I get into the micro or the small units, I think they're generally left high and dry. They're the ones who are fending for themselves.
But I have one small follow-up question for you. Your impression that we should not worry too much about the US Fed movement and all. Can you tell our audience what is the reason for your confidence? Because in 2008, we had a problem. In 2013, we had an immediate problem. So tell our audience that what are the factors which weigh in your mind to tell us that we are not as exposed as we were there in the past?
Well, actually, there are two reasons, sir. See, one thing is that ours is a domestic-oriented economy. So how much ever we like to say we are globalized and we are giving a big push to exports, but finally the Indian economy performs if the domestic economy performs. So therefore, what happens to the Federal Reserve, what the ECB does, whether the rates go up or down, and we have openly said it that I think the RBI has maintained saying that we base our interest rate decisions based on what are the domestic conditions. So while they do keep in mind what's happening, as I mentioned, that there is an impact which comes from the external side. But otherwise, if you look at my demand, I need to create jobs. And as long as I don't create jobs, there's no point in me worrying about what the Federal Reserve is doing. Because today, if you look at the problem in India, I think we have spoken on investment which is done. I think Aditya has given a very good explanation. But a major problem in India is consumption. This was a pre-pandemic issue which we had. We're not creating sufficient jobs. Now, we can always have this argument of saying that unemployment has gone up, down. I'll show different kinds of data to do it. But at the end of the day, if jobs are being created, people are consuming, the economy will automatically boom. We don't really have to think too much about what the Federal Reserve is doing. But the markets, of course, are very crazy because every time they would say that the Federal Reserve is going to do something, everybody is worried about it. The rates go up, they go down. I think that's what is happening. Like we all know what's going to happen tonight, but everybody's jittery about it. All of us are going to keep our laptops on, and I'm going to do the same analysis, which we know what is going to happen. So to my mind, yes, this from the market point of view, it is something which all of us as professionals, as long as I'm working, even I'll be concerned about it. But if I look at the basic growth which takes place in India, it is a domestic phenomenon. We need to tackle those problems to bring about growth. And I think what Mr. Siraj Hussain will agree, I think unless we focus on agriculture, that's one major piece which we have never focused on. We've just taken it for granted. Okay, it's helped us during pandemic times. Have we brought about a second green revolution? No, we have not brought about it. Any kind of improvement we want to bring in agriculture, there are enough voices to push it back. It becomes a political issue. So not getting into that. But I don't think we need to really. So to my mind, I think the Indian economy is fairly insulated because growth comes from within. And in terms of the Federal Reserve, yes, external sector impact will definitely be there on us, but not something which will derail the Indian economy. And even in the past, in fact, Mr. Sinha, in the past, I remember in 2008, all of us with lots of hubris said, no, decoupling has taken place. Look what's happened to US and India is so great. We all pleasure in that, yeah?
I have one follow-up question which has come from the audience, but I'll come in the second round. My question now is to Mr. Siraj Hussain. In your earlier intervention, you did mention that the Ukrainian situation also gives us an opportunity for higher exports of wheat, for example. So my question is, does it only provide an opportunity for us, or does it also pose any fresh challenges? And how well do you think India is prepared? Maybe in the area of edible oils, maybe in the area of wheat, maybe in the area of some other agriculture commodities. And my second question is, government had to go back on its earlier reforms agenda, what they thought was the reform, but then because of political reasons, they had to withdraw that. So in view of these changes that the government has made, what do you think is the way forward for next 2 years or next 5 years? How is it going to affect the rural economy? How is it going to affect the agriculture economy? What is the way forward? Not in the very long period, but maybe in the next 1, 2, 3 years. So these are the two sets of questions.
Thank you, sir. Now, I think I have a different take on the subject of India's surpluses. Many economists have been writing over the last few years when market prices were very low that India has become perpetually surplus. My own sense was that except for wheat and for very wrong reasons, rice, our surpluses are very marginal. And I think the last 2 years have proved that we have had to import corn, we are importing pulses anyway, we are importing a lot of edible oils, the imports are going up and up. And at one point of time, we floated tender for import of potato, of all the things from Bhutan. So our surpluses are quite marginal, in fact. And also, I would say that many of these agricultural commodities sometimes in years of glut look surplus because the per capita consumption is very low. People do not have purchasing power, and therefore, it gives an impression as if we are surplus. So, given the Ukraine and Russian situation, the Black Sea ports are closed. Even then, I do not think we will be in a position to export corn in a very large quantity. Reason is that if corn prices rise, the poultry industry is going to go to the government and request for some kind of restrictions on export. Now, we have seen even during the enactment of farm laws that the government, banned the export of onion. In fact, it was very early days after the enactment, and the export of onion was banned. So we may well see restrictions on export of corn in the next few months if the Russian attack on Ukraine is not contained. In wheat, of course, we are surplus. It is a good opportunity. But as I said, if the government decides to continue with extra allocations, with a view to reach parliamentary elections, with welfare agenda succeeding in these elections. And if we really think, if the government really thinks that it needs 90 million tons instead of 60 million tons, which was estimated at the time of enactment of NFSA, then I think the government will not be very happy with very large volume of even wheat exports. Now, we have seen between 2000 and 2004, when Vajpayee government was in power, we were in a similar situation and India exported huge quantity of wheat. And by March of 2006, our stock of wheat was half of buffer now. Instead of 4 million tons on 1st of April 2006, we had only 2 million tons. And then over the next 2-3 years, we had to import 55 million tons. So I think even in case of wheat, the government is going to be prudent. And I'm sure the government would be assessing the situation. But having said this, there is a good opportunity for export of wheat. Now, coming to farm laws, I think, we are entering a rather bad phase, if I may say so, because sitting in Lucknow, I read in newspapers every day that the first decision of the government is going to be free electricity for agriculture. I also learned from my friends in Punjab, bureaucrat friends, your juniors, Mr. Sinha, that they are already working on free electricity and 1,000 rupees for women. In UP, they are working on, higher support for widow pension and all that. So this is going to put pressure, and our economist friends on the panel must take these commitments made in the manifestos into account when they forecast what is going to happen to Indian economy. So, but it does not mean that there is no scope of reforms, because what has happened is that the ball is now with the state governments. And as far as I am concerned, my sense is that the states would be realistic enough to provide the support needed for higher growth of agriculture sector. Now, I will end by saying that we need a much higher investment in research in agriculture. There are a number of success stories in agriculture. For example, we are exporting so much of rice. It is due to a new variety called Pusa 1121, which has changed the situation enormously. Similarly, a new variety of basmati rice 1509 has changed the situation. The export of grapes, we are touching some 2,000 crores every year. That is because of investment in supply chain, spearheaded by Mr. Sharad Pawar in Maharashtra. A very ultra-modern testing lab in Pune, etc., etc. In case of apples, there is a very good supply chain. We now get Indian apples for 8 months a year rather than 2 or 3 months a year earlier. So there are a lot of small little success stories, but we need to do much more. And I'm not very sure if we will find resources for that. If welfare support is going to be dominating the system in the run-up to 2024, then I'm not sure what will happen to investment.
Okay, thank you. Thank you.
So can I just say one thing, if you don't mind? It's just in a lighter manner. I'll just say a sentence, actually. In my earlier avatar, when I was working in a rating agency, we had once gone to the Punjab government and spoken to them about free electricity. So the secretary out there told us very clearly, he said, you people are so capitalist. When you give so much of subsidy to industry, everything seems to be all right, including your PLI. When I give it to a farmer who's producing grains which you are eating, you find an objection to it. So I just thought I should say this. I found it quite funny, in fact.
Okay. Now I'll come to you, Lakshmi. What do you see is going to be the stance of the monetary policy in India, and can you have a path in your mind for the next 3 months or next 6 months or maybe next 1 year, and what is going to be its impact on the financial sector? What is going to be its impact on the general economy, and more particularly on the investors, those who are investing in mutual fund, for example, what sort of scenario they should be prepared for?
Sure. So if you look at the policy stance so far, it has continued to remain accommodative. However, the Reserve Bank of India has already implemented a normalization of liquidity. As I said, we are, actually in the last 2 years, we were in the weight gain mode, and now we have slowly but steadily gone into the liposuction mode, where the surplus liquidity is getting normalized to, I would say, adequate liquidity. I won't say deficit of liquidity. Now, in that process, we have already seen the yield curve shift upwards. So much so, if you look at the OIS curve or the interest rate swap curve today, it is suggesting to you that over the next 12 months, there is at least 75 to 100 basis points in that range, depending on which year tenor you're looking at. It is telling you that there is 75 to 100 basis points of rate hike. And when I say rate hike, I'm talking about the repo rate hike. If you ask me, our view is, will RBI take such a harsh call, especially given the fact that growth is faltering in quite a few parts of the world, And even in India, there are some sectors which are showing, output gap. It looks very difficult, at least for me to envisage right now, more than a 50 basis points rate hike on the benchmark, which is the repo, given the fact that inflation, even right now, is within RBI's tolerance band. So if you look at FY 2023, even if inflation remains towards the right-hand side corridor of the RBI's threshold, which is closer to 6%, even then, repo rate going up by 50 basis points is something which could be a reality for this year, 2022. From a markets perspective, as I mentioned, the markets have kind of priced this in already. So between the two evils, I would say expectations on the monetary front vis-a-vis expectations of the government borrowing the week-on-week supply. On an average, 28 to 32,000 crores of weekly supply will hit the bond markets starting April 2022, that is next month. I think that is the bigger evil in the room. So therefore, there are market expectations of RBI to probably have some sort of an operation twist, wherein they buy long bonds and they supply short bonds. What could this mean for investors? Well, I would say 2022 for fixed income investors could be the year of the carry, which means try to focus on high grade portfolios with optimal, with I would say moderate durations, and have a reasonable portfolio yield. So you try to enjoy the carry. So between carry and capital gains, looks like there is going to be prevalence of carry into your portfolio. From a financial sector borrowing standpoint, I think the borrowing costs have already started rising, which will finally and eventually impact or start impacting the financial sector balance sheets. They may have to obviously pass on the cost, whether you are a lender or you are a banker. Finally, the costs will have to go up. And that would mean, probably higher borrowing cost from an investor perspective, especially if you are out there to do some leverage.
Good. One more question. If I'm an investor in the market, maybe through mutual funds, I also see that the bank fixed deposit rates have started going up. So how do you see this interplay in the next 1 year or so? Will the fixed deposits of banks become more attractive, or do you think that investments in the mutual funds are likely, I'm not saying with any certainty, are likely to remain attractive? And what sorts of investments people can think of making in the industry?
Clearly, banking products have a magnetic pull. So whether you are an iron or no, there is a magnetic pull, whether you're a wood or an iron. So I think that is the attractiveness which bank deposits or bank products do carry right now for the investors. However, I must hasten to add that the market rates, or which is the underlying bonds, CPs, debentures, etc., tend to get repriced faster than the pace at which banks tend to reprice their liabilities, which in this case is fixed deposit rates. So I think initially, as I said, as portfolios, realign themselves and make investment at the current prevailing rates, there could be a possibility of market-related performances and market-related gains potentially accruing to the fixed income investor. So unless you are fixated on certainty, I want something assured, I want something guaranteed, which obviously a mutual fund product cannot. Unless you are that category of investor, you could certainly do with investments across a suite of fixed income strategies. And in this market and in this scenario, as I would call it, which is a guarded environment, I would say, I call it, by the way, colloquially, the Zor Ka Jhatka Dheere Se categories, which are, I would say, moderate duration, anywhere in the band of 1 to 3 years, focus on floating rate instruments, which is market linked, and therefore, the rates also get realigned with the interest rates. I think these are some of the categories which investors for fixed income specifically can focus on. One more category which I want to add to this, fixed income typically is like a nimbu pani, which just offers stability to your portfolio. So if you want that little bit of tadka, you add a little bit of caffeine. So there are debt hybrid strategies trades, which have a small amount of tail-ended equities as part of your portfolio. So I think a combination of this, I think, would be a good suite to have in this kind of a scenario.
Okay. Radhika Gupta, by and large, it is understood that the mutual fund industry has done quite well in the last decade or so, which was not the case prior to that. So, and we all noticed that while we are seeing continuous outflow from the foreign portfolio investors in the last few months, the market has held up, and it's primarily because of the support that the market has received from the mutual fund industry. So going forward, what are the challenges that you think the mutual fund industry has, and how well is the industry prepared to deal with it? I'm also asking this question because you are now the vice chair of the AMFI. So even in that capacity, you kindly reflect upon this.
Absolutely. I think so. I think over the last 3-4 years, and credit to SEBI, the market regulator, and AMFI, a lot of work has been done by way of regulation, both on the fixed income and equity side, to make sure things are far more stable. Whether it is on the fixed income side and the risk management side, particularly after a couple of the credit crisis, I think we have done a lot of work in terms of making fixed income portfolios much more transparent, stable. A lot of risk management guidelines have been put in. Scheme categorization happened on SEBI's part and was implemented by the mutual fund industry. So today, I think, we stand in in an unbiased way. I think we stand in a very good place in terms of transparency and regulatory framework. And I truly believe that a lot of the growth that has been driven is a function of this transparency, this regulatory framework, because I think when people buy a mutual fund today, there is a certain sense of trust. Finally, the tagline that is mutual fund sahi hai, the word sahi hai carries a lot of weight, and you have to really live up to it as a reputation. I think there are 2 or 3 challenges and opportunities for us. I think the clear opportunity is that we are still miles away in terms of penetration. So we only have 2 crore mutual fund investors. I don't know if my data is accurate, but someone alluded to cryptocurrency today. And I think there are more cryptocurrency investors in India, as per some reports, than mutual fund investors. So to take this message
your data about mutual fund industry is about unique PANs. So,
unique PANs.
The same may not be true for the investments in the cryptocurrency.
Yeah, and
don't be disheartened by that.
Thank you. I think the broader point, though, sir, is that mutual fund is a simple product. And in times like this, sometimes, direct investing in stocks, investing in instruments like cryptocurrency, that takes precedence. So to direct more and more investors into this simple product, because ultimately, if you invest in a basic index fund or a basic equity fund via an SIP, I do believe a lot will not go wrong, and I do believe a consumer will make money. So I think broadening the net of mutual fund investors is extremely important. Broadening the net also of mutual fund advisors is extremely important, because our belief is that when people come in with the right advice, and India has a severe shortage of advisors. In fact, AMFI is doing a couple of tester projects to this tune as we speak to expand the advisory industry. But really, we need to expand the net of mutual fund investors and advisors. We have seen a lot of growth in the B30 segment of the market in terms of investors, but we need to continue to support that. I think the second challenge for us is that a lot of investors, and I said this in the first part also, but I will reiterate, have come in with very, very high expectations. And, there were a lot of comments about ultimately the market will be driven by earnings, but it was also a big beneficiary of the large amount of liquidity that we saw in 2021. As that liquidity goes away from both the private markets and public markets, I do believe 2022 is going to be a tougher year for capital markets than 2021. And all those people who came in 2020 and 21 came on the back of very high expectations. So how do you manage investor expectations in a year like 22, when you've come and seen that my mid-cap fund has returned 30% and, my small cap fund has returned 50-60%. Organically in conversations, when you talk to investors, their expectations of equities are well above 20%, which we know is not a realistic outcome. So I think realistically managing investor expectations is going to be something that is very, very important for the industry. So I think that is the opportunity and that is the challenge ahead of us.
Yeah, I'll come to Mr. Sabnaves. During your intervention, there was one question that perhaps needs to be covered. That aspect needs to be covered. Maybe we have not covered sufficiently on that point, which is about our import dependence. While we are saying that this is not the same as 2008 or 2013, and we are better prepared, but look at our current import dependence. What sort of comfort does it give you? How better prepared we are, and how are we going to navigate into this situation?
If we're talking in terms of imports, I think the major component there, which we're talking of, which has probably today a share of around 25 to 30% is oil, over which nobody has any control. I don't think there's anything much which can be done in the immediate run. There is, of course, a lot of talk about how do we move into renewables, EVs, and all that which is going on. But to my mind, that is more of a medium-term kind of solution where we can reduce our dependence on oil. Now, in terms of the other imports which we're doing, at times we have a coal problem, so therefore we need to import coal. As we had late last year, 2021, we had this problem. Gold imports is another major component which comes in, but the rest of them I think are majorly there are imports which inputs which go into the final products, if you're looking at certain chemicals or engineering goods. So I don't think there's anything for one to prepare for. So unless we are going into the situation of saying that I'm importing, I'm going to produce everything that I was importing earlier. So that kind of an import substitution kind of a theory doesn't really work today, because I think everybody works on the basis of producing the most efficient manner. So I would go back to the Ricardian theory of comparative advantage. And the fact that we have free trade or foreign trade is essentially to make sure that you're able to leverage better quality and low cost products from outside. So the import bill will continue to be where it is. And I think, we have seen it being increasing, commensurate with the kind of growth which is taking place in the domestic economy.
Very well. Now, I have one general question. Anybody can intervene, and we don't have to be either too protective about our regulators, or we don't have to be too critical of the regulators. But factually, how do you feel? Because we have instances where there have been weaknesses in the way the banking companies or non-banking companies have been regulated. We have episodes, I'm talking of developments in the last 5-6 years. And recently we have this case where there is a perception of that the stock exchange was also perhaps not well regulated. So what sort of comfort can you give to your audience about the regulatory area? Or if not, if you feel there is that comfort is lacking and there is tremendous weakness, then what do you think is the way forward? What should be done? Either way, anybody can come in, please.
If I were to say something here, I'll stick my neck out. I'll say that regulation is something which is always evolving. Because if you see the problems which take place in the financial sector, if I go back to the MFI crisis which was there, if I look at the NBFC crisis which was there, and probably we're talking of the stock exchange, or earlier even in the commodity exchanges we saw in the spot market, I think it becomes very difficult for any regulation to cover all aspects. And there will always be the wrongdoing which happens when somebody sees that there is no regulation out there. Like, for example, I remember there was a time when for MFIs, people felt that was the greatest thing happening. Nobody found anything wrong in charging interest rates of 30 or 40% per annum. It was only when we had a crisis kind of situation which turned up people committing suicides that we saw regulation coming in. Similarly, I remember when we had the NPA problem of banks, everybody felt, look, NBFCs is the greatest thing. They have last mile connectivity. They're the ones who are actually doing great stuff, growing at 15-20% per annum. And then we suddenly saw that things were not that clear. So I think it's, when I say regulation is evolving, I think when we are talking of new kind of institutions, it's obviously a case of saying that RBI was not regulating all these institutions institutions in the past. Suddenly they become very big, then you decide there's a problem and then you regulate it. The same thing happens even in terms of the securities market. Since I worked in the commodity market, I would say that it has been an evolving process. And I think we never had a spot market which was part of an exchange. Then when you had problems which coming in, then it's easy for me as a critic to say, why was the regulator sleeping? But did I have an idea as a critic to come up with this idea before? No, the answer is no. It's none of these problems are things which we intelligent people have highlighted and the regulators not looked at. So I think when you have new institutions, that's why I'm worried about crypto, because crypto has now taken some kind of a huge size, which, I mean, the dimension is too huge. And later on, when we get to know something is wrong, maybe then somebody will say, why didn't you regulate it? So I'm sorry, I'm not giving an answer, but I'm just saying that it's one thing to say the regulator is behind the curve, but then let somebody come up and say that, look, you should do such a thing. Okay, if today I feel there's something wrong in the cooperative banking system, let me come up and say that, look, these are the problems. None of us think there's a problem until the problem comes.
Sir, I would jump in here with one point. Two things I would say. One is I absolutely agree with Madan that regulation is evolving, and India is a very young capital market. So even the instruments that are coming to markets are evolving. And I think in seeing SEBI very closely, it is a balance between regulation and market development. And I think from a mutual fund point of view, we are actually striking the right balance. So we have had growth of industries like passive funds, which perhaps didn't exist. We've had growth of fixed income market. All of this is happening and we are learning as we are making mistakes. I think two places where regulation needs work and attention. One is the IPO market. A lot of retail investors are coming into the IPO market. Companies are getting increasingly complex and they are not the old business models of the past. They are not necessarily profit-making companies. We don't expect SEBI to determine IPO pricing, and to some extent this has already happened, but no retail investor is going to be able to make sense of a 500-page DRS. A fund manager is barely able to make sense of that. So thinking about the IPO market, when a company can list, how much can be OFS, I think thinking about the contours of the IPO market perhaps needs some work. And I absolutely agree with Madan that cryptocurrency, both from a regulatory status and from an advertising point of view, with so many celebrities coming in and talking about cryptocurrency and setting expectations, I think that needs work because it's just spread to both of these IPOs and crypto have hit a large number of investors.
I think somebody who is not from the market has a comment to make. So I invite Mr. Siraj Hussain to offer his comments.
Thank you, sir. Sir, my suggestion to all the regulators, not only SEBI, is that they should not engage themselves in micromanaging even very small matters. What is happening is, I am the chairman of a company, which is subsidiary of commodity exchange, and I find that the regulation is the same whether you are a 5 crore company or a 5,000 crore company. So just to give you an example, a nominee director of State Bank of India has to be approved by SEBI and WDRA and everyone, and it takes 4 or 5 months to approve a nominee director of State Bank of India, a serving officer. So please tell your successors in SEBI and everywhere that they should trust the existing systems of the government and not waste too much of time on managing things which make no difference.
Okay, Aditi, one question on which, if you have a view, I would like to hear. Actually, two, but very short questions. One is about the revenue forecast which the government have and the disinvestment target which the government have. What is your take on this? And second is about the IPO market and some of the new age companies which saw massive decline in their market prices from the issue prices and all. What are your thoughts on that?
Sir, I'll take the first question. So as far as the revenue and the disinvestment targets are concerned, I'll first speak about FY22 and then I'll speak about FY23. So for FY22, we've already seen that the revenue receipts target has been revised upward in the revised estimate as compared to the budget estimate for FY22. And we're fairly certain that the actuals are going to be another at least 50 to 90,000 crore higher than even the revised estimate. looking into fiscal estimates from both the government of India and the state governments, in a sense, I feel there's been a lack of conviction in the revenue upturn, which has been there since the second half of FY21. So, with the kind of strict lockdown we had in the first wave, the estimates of how much revenue could be collected really saw a severe beating. And since then, what I feel has happened is that the upturns have been underestimated. There has been a lack of conviction, in a sense, in the kind of broader trends that we've seen in the last 12 to 15 months. One being that with the K-shaped recovery, we've seen very strong corporate tax collections. We've seen very strong GST collections as well, high inflation, shift to the organized sector, better anti-evasion. All of this has really supported healthier tax revenue growth of Government of India. So the sense I have is that in FY22, the gross tax revenues are going to be 50 to 90,000 crore higher than what is being put into the revised estimates, which can easily offset the spillover of LIC IPO inflows from FY22 to FY23. Another reason I believe that we are in for a better than expected tax performance this year. Yesterday, we found a monthly document about transfers to the states, where actually we've seen almost like a triple tranche of central taxes being devolved to the state governments in the month of February. So clearly, the situation is much better than what the revised estimates had penciled in. As a result, what we got for FY23, the embedded growth in tax revenues is actually going to be quite modest. Also, the nominal GDP growth, which has been assumed in the budget over the second advanced estimates for FY22, that growth rate works out to just 9.1%. Even if inflation, even if growth has hit because of the war, and I think one of the other speakers was also saying about 50 to 100 basis points below the baseline, and I would agree, we're probably going to be somewhere in the range of 7 to 7.5% real GDP growth, but inflation will then be negative, so that's going to add. So we probably are looking at a nominal GDP growth being somewhere in the range of about 13% in FY23, which is much higher than what the government had penciled in. So that suggests, and specifically the GST collections, the kind of numbers we've seen in the last few months, we think there's a clear upside over there. Excise, it's anybody's guess right now whether we're finally going to get that cut that we keep talking about. I don't know. If it is there, the loss that we are projecting to Government of India for a rollback going back to the pre-pandemic levels is about 92,000 crore. It's not small, but I don't think it's unaffordable in the light of the kind of conservative tax revenue estimates that we are seeing for FY23. But there is another concern which I had briefly mentioned earlier. If margins are going to be under pressure, then perhaps we need to be prepared for a lower corporate tax growth in FY23. So on balance, I would say that LIC spilling over from FY22 to FY23, possibly it's going to provide more stability as far as the revenues are concerned, the overall capital plus revenue receipts. And it's going to impart more stability as far as meeting of the fiscal deficit target is concerned.
Yeah, but what is, two things are in my mind. One is that maybe a good portion of the revenue growth is also on account of the earnings from oil and gas, petroleum related earnings. And the second question, and in fact, the second point worries me, because now there are states after states which are raising their voice that the guarantee about the compensation should be extended. So this is a worrying thing, and I don't know what political turn it will take. But this puts a question mark on how robust revenue system we have been able to evolve over the last 8-9 years. So let us see. There is one question from the audience, and I think the question is about why is the mutual fund industry not being allowed to gather money here, to collect money here for investment outside the country. But my impression is that RBI has come out with some more relaxation. Can anybody clarify that? What is the correct position? Yes.
I can take that.
Yeah, Radhika, please.
there is a $7 billion limit for investment in overseas funds. And that was breached around the 1st of February. And because overseas funds have really been growing as a segment over the last few years. RBI, SEBI and AMFI have written to RBI to relax this limit and widen this limit. RBI has not yet come back. I suspect this period of currency volatility and global market volatility, I can't speak on behalf of them, is perhaps causing them to think about this. So we are all waiting for RBI to come back. But of course, the industry has written and spoken to RBI multiple times, and they've said they'll consider it, but it's not done yet.
So we have now 5 minutes left. So either Samir or Dr. Dhanjal have anything to say. Otherwise, I like to make some closing remarks and close it. But they are welcome. Either of them are welcome, or both are welcome.
Well, I have one remark which is absolutely unrelated, but has got to do with what Mr. Siraj Hussain said about micromanaging. And I see that both the regulators are killing financial literacy by micromanaging it. They have taken over, RBI has taken over almost charge of banking industry financial literacy funds, and SEBI has taken over charge of financial literacy funds of all the stock exchanges and so on and so forth. And they're putting so many of caveats, and the capitalist regulator, which is supposed to say regulate stock markets, is of the opinion that financial literacy should be not for profit. RBI also thinks only NGOs should do it. Then they say that financial literacy should be a self-evident need, and people should come and ask for it. Now, if there was such a self-evident need, India may not be poor. So they should stop, micromanaging financial literacy funds and marketing funds. In one regulator's case, they've even taken over marketing funds. And they say if it's a SKOCH conference, you can get 50,000 rupees. If it's a Government of India conference for the same thing, lesser discussion, you can pay 15 lakh rupees. Now, so this is the level of regulator interference in day-to-day business, when there is a riot going on under their noses in so many other areas. So I think micromanaging, stopping that, is a very, very crucial area. That's all I have to say. Siraj ji, आप कुछ कहना चाहेंगे इस पे?
नहीं, अब अगले सेमिनार में बोलेंगे साहब.
Okay, Gursharan ji, any comment from your side?
I'm good.
Okay. So I think we are now towards the end of this session. I want to thank the organizers, and I want to thank profusely all the panelists. I think we had some very scintillating discussions, some very in-depth points were made, some very incisive points were made. I think I have come out from this session by learning a lot more than I did at the beginning of this session. Such a discussion is very difficult to sum up, but 2 or 3 points which come to my mind are, for example, that there is a genuine comfort that this time is not going to be a repeat of 2008 or 2013. India is much better prepared, and the regulators and the government and all are working together to ensure that whatever impact is there, it is dealt with in a very, very smooth manner. I want to acknowledge the points made by Siraj Hussain. He gave some very interesting and incisive ideas about the agriculture economy and what India is doing, what potential it has about exports, and also the withdrawal of the farm laws and what challenges these are going to place. I think his message was that different state governments and the central government will have to work together on this policy area so that they can come out with something which is cohesive, and that will help the farming community, that will help the country. We had some comment on the regulatory space, but I think as expected, the comments were rather muted. But one point came out very clearly, one takeaway from me is that regulators, maybe in other parts of the world, but definitely regulators in India are behind the curve. And when they are behind the curve, they need to take note of it, and they need to engage with the industry, they need to engage with the investors and the depositors and other stakeholders in the banking industry, and then take it forward so that we come out with the best policies and programs. One comment I have for the mutual fund industry, and which is based on my own association with the industry in the past, allowing mutual fund industry to come out with advertisements had been a very difficult area for SEBI. And with great thought, it was allowed. As a layman or as an outsider, when I see some of the advertisements, I feel that AMFI and the regulator should also look at it more seriously, because the pendulum should not swing from one end to another and then maybe create problems down the line. In the end, I'd like to thank all of you. It has been very enriching for me. I have learned a lot. And thanks to Samir, thank to Dr. Danjal. Thank you all, everyone. Thank you. Bye.
Thank you very much.
Thank you.
Thank you so much.
Goodbye, everyone.